and welcome back to the show this morning. I'm your host, Lance Roberts. Danny Ratliff joining me, of course, because it's Wednesday. That's what we do on Wednesdays. Danny Ratliff joins me. Good morning. How are you, sir?
Good morning. Doing well. Thank you.
Awesome. So what's on the agenda this morning? What's happening in the world of financial planning and personal finance that will excite and intrigue us?
Incite and intrigue you. Well, if we're going to incite and intrigue
not
Lance, we're in trouble.
No, not insight, excite.
Well, there's a couple things. So obviously, retirement has swelled during the pandemic. So lots of studies that are coming out now suggesting that many more people retired than what initially were expected, which makes sense.
Yeah,
a lot of people were forced.
I was going to say, can we quantify that? Retirement's usually deemed as an optional thing, like it's something that I chose to do, not when somebody tells you have to retire.
Correct. So, that is a big thing. They're saying actually 1.7 more older Americans actually were forced into retirement. And some of it was a little bit, was by choice because they said, you know what, hey, the risk reward scenario isn't as great. We were looking to get out of here anyways. Now may be a good time to hit the exits. But many people who wanted to continue to work were unable to. And so I think that poses a bigger issue. We've seen it. We had a lot of clients who were hoping to continue to work for a handful of more years who were actually forced into it. We had to readjust a whole lot of plans. And I think that's going to impact consumption for, quite some time. We talk about the demographic issue that we already have, Lance. Mm-hmm. This could actually present a completely different problem that maybe we're not even taking into an account.
Well, I think there's really two things when you really think about this is that, first of all, let's break down the demographics of the country first. The top 10%, and there's actually a great chart out we posted out on our Twitter account this morning showing who holds the most cash, right? Who has all the cash. So the top 10% of income earners own about 70% of the cash. The next 40% own basically the balance of the cash. The bottom 50%, which is interesting because on this chart, they actually stated the bottom 50% are the working poor, right? And that's hard. That's the change dynamic we've seen over the last 20 years has been this middle class has shrunk dramatically. The working poor is generally your bottom 20%. They're now 50% of the population. So my point about this is that the clients that you and I talked to, Danny, that were forced into retirement. These are higher net worth individuals
Correct.
that have money to invest and they've done a good job savings. They've got their nest egg put away. And so they're going, I was kind of forced to retire. Risk reward really wasn't my favor, but I'm okay. The reality is that about between 80 and 90% of these people that were forced to retire, they're now working at Walmart, driving an Uber, driving in a Lyft. They're not retiring. And that's one of the big problems with these stats that we get, from the government talking about labor force participation, which adjusts for who they think has retired. And they go, we have 10,000 people a day retiring. They're not retiring. They may step out of the full-time labor force, but now they're working, 1, 2, 3 part-time jobs just to make ends meet.
Yeah, that's exactly right. And this study does actually show that older workers without a college degree are actually the ones who are most represented in these numbers. Mm-hmm. They're the ones that are having a difficult time staying on and finding work.
Yeah.
So I think you're right. You're probably going to see more and more of that gig economy, which is interesting because, we classify that gig economy as your Uber drivers, as the people who are delivering, doing all these different things. And now I think it's probably they're doing more DoorDash than Uber, right?
Right.
Because there's just the dynamic has shifted so greatly.
Yeah. Well, look, and that has huge economic implications that a lot of people don't think about. Is we often look back in the 50s and the 60s and we go, wow, America was great back in the 50s and 60s, and we had 8% economic growth rates, we had high savings rates. Yeah, interest rates were going up because growth in the economy was growing, right? But we were manufacturing. We were manufacturing everything. We made everything from blue jeans to televisions right here in good old America, and we were shipping it out overseas because we were rebuilding most of Europe and Japan after World War II. The difference today is these service businesses that we have, the gig economy, right, are the lowest wage paying jobs. This is why Uber's fighting so desperately right now in California to try to keep their drivers from being classified as employees so they don't have to pay insurance, health benefits, payroll taxes, all the other things. They just want to pay their drivers 1099 and be done with it. But that drives, and that's why, really, more importantly than anything else, A, we don't get stronger rates of economic growth, but B, this is why you've got this swelling of this bottom 50% of the economy that are now the working class poor.
What's the fix? Well, I mean, where can we correct this?
You can't. That ship sailed. This is the funny thing, right? No, this is the funny thing. Politicians, all come up and they all say, look, President Trump, make America great again. He had the right idea, bring manufacturing back to America. The problem is his whole strategy was very misguided. You can lower tax rates. That's not the problem. The problem is that we as Americans have all gotten used to having or demanding, right? We want $15 an hour minimum wage. We want health care benefits paid for by the company. We want vacation days. We want paid time off. We want maternity leave, paternity leave. We want child tax care. We want all this stuff, right? And Brent and I were having this conversation the other day. If I hire somebody for $50,000, and Danny, you know this because you and I work on payroll budgets, when you hire a new employee, it's not just $50,000, it's $50,000 plus another $25,000 a year for all the other stuff. And when you're competing with countries that pay $2 an hour at best, in a lot of cases, no benefits, no time off, no nothing, you can't compete with that. You cannot import manufacturing into the country today because nobody will be able to afford the cost, right? It's like, oh, let's manufacture here. Let's manufacture stuff in America. Great. $5,000 for a television versus $150 at Walmart. That's what you're talking about. So you can't fix it. This is how the economy works. We all want more stuff. We want it cheaper. And the only way we can do that is to export inflation through labor cost and offshore manufacturing and import deflation through cheaper prices. That's it. You can't change that. You can't change it.
Yeah, which it won't happen. And if we want to be like Europe and have all the social programs like they do, then there's no way you're going to be competitive.
Well, and this is the problem with this $3.5 trillion spending bill. You're only going to make the situation worse. Yes, for 12 months, you're going to have a boost to the economy. So if I was Joe Biden, I would pass this bill in the late third year of my presidency because for 1 year, I'm going to have a boost to the economy. So I'm going to go out as the president with a really strong economy for 1 year, and then everything's going to revert back to the norm. And because inflation will price everything in, that's what's going to happen with this bill. We're going to get further into debt and have no productivity out of it to pay for the debt. And that is the overriding problem that's been plaguing the economy, not for 10 years, not for 20, for the last 40. So anyway, now you got me off on a different stick, and this is your show today. So what else you got?
So, child tax credits, we've talked quite a bit about this. In July, people started to receive their first payments. There was a big change to that. If you're accustomed to what that child tax credit is, it's typically they've given you a $2,000 credit per child. They actually increased that to $3,600 for a child under 6. If they're 6 to 17, it's $3,000. But the big caveat, two big changes that occurred, were that they were going to actually pay you half of that throughout the year. And so those checks started to go out in July. And now we're actually seeing that this is a fully refundable credit. So even if you don't have a tax liability, you're going to get a potential refund from this tax credit. So it's pretty interesting as far as how they've worked this. Now, you want to talk about big numbers, Lance. 60, the numbers are actually astronomical as far as how much money went out. Just last month, $15 billion went out in the form of child tax credits. So, I mean, think about that.
Yeah, no, and it's interesting because my wife, gets deposits now once a month of these child tax credits. What's the consequence though for higher income earners? Those do become taxable, right? Because they're just they're kind of just sending stuff out willy nilly. They're not really looking at who needs it or whatever. It's like, oh, if you've got it, unfortunately, I don't have any dependents, so I don't get a check. My wife does, and my ex-wife gets all the checks. But where?
Wait a second, isn't that where all the money goes anyways?
Yeah, I know, right? It's just, But what happens to a lot of people that are taking these checks or spending it? Is there a tax liability down the road potentially?
Well, there are income limitations, and so there are people who are receiving them right now who may want to shut those off or be prepared to later, pay those back. Because if you're over those income thresholds, that could be, you're going to have to pay some money back. And so, depending on what your tax bill looks like, just be prepared. And I think that's where people are being set up for failure in this instance. If you're not being diligent with this and understanding exactly, hey, maybe I shouldn't be receiving these, or if I am, I need to put these aside. You can also contact them and have them stop it. It's fairly easy to do.
Sure,
But
you know this. I know this. 99% of Americans don't know that. There's money showing up in their account. Well, I shouldn't say 99. 90% of Americans don't know this, right?
Correct.
Money showing up in their accounts, and they're going, hey, I got free money. Let's go buy something.
That's right. That's right. I mean, most people, it comes in, it goes out, and that's unfortunate because nobody's going to read the fine print here. And come tax time next year, I think there's going to be a lot of surprises.
Yeah,
because they didn't do a good enough job letting people know. Now, I will tell you this: President Biden did send me an official document letting me know that he was going to send some money. I thought that was pretty nice.
Nice. All right, when we come back from the break, we'll get into this. So one thing is these child tax credits, the way they are now, this expansion ends at the end of this year, unless this $3.5 trillion package gets passed, which will permanently, well, at least for 5 years, expand that again. So, the problem with anything that you do where you expand Medicare, Medicaid, any type of government benefit, the problem is once you do it, it becomes permanent and it never gets repealed. This is the problem with all spending in government. It never goes away. All right, be back after the break. Pick up more with Danny Ratliff. Also, we'll touch on just a bit here about S&P 5000. I touched on it at the beginning of the show, but we'll get a little bit more into that next. Don't go away. And welcome back to the show this morning. I tell you what, if you go by our website, realinvestmentadvice.com, like the ad just said, you can get our latest blog posts, videos, everything is there for you. Our daily market commentary, a new feature we're now offering out every morning. Simply go by the website, realinvestmentadvice.com. It's right there under the main banner. It says daily market commentary. Today we're talking about S&P 5000. Also has everything you need to know before the market opens in the morning, earnings, economic data, top news. Everything's there for you to help you kind of go with your cup of coffee, get you started for the day. And if you want to, you can subscribe to it. There's a link to subscribe to the Daily Market Commentary email. We'll just email it directly to you at 7:30 a.m. Central Standard Time every morning, so you'll have it. And this morning, Michael Leibowitz is going for clickbait title with his newest post, What a Miami Stripper and a Fiscal Elephant Have in Common. Ooh. So I'm not even going to tell you what it's about because just...
I'm just curious how he decided that he was going to start studying these two things. Well, sorry, honey, I had to do some analysis here.
Okay, well, see, now if I explain it, right, it's going to kind of ruin the article, but the article is about The Big Short. Michael Lewis wrote an article about The Big Short, and in the movie and in the book, The Big Short talks about a Miami stripper who was taking on tremendous amounts of mortgage debt to buy all kinds of houses because you could back in 2008, right? So,
yep.
And it has a lot to do with what we're doing with our debt right now. So, clickbait-wise, it should work very well.
So you're saying the research wasn't as much fun as it sounds?
Yeah, exactly. No, it wasn't. Anyway, a couple of things this morning to get into as we kind of left off, talking a little bit about these child tax credits, of course. Now the government's talking about the passage of this massive spending bill. And again, as we said, kind of winding up that last segment, that the child tax credit expansion ends this year. And this $3.5 trillion spending package is set to expand that credit for 5 years. So, there's just, again, kind of this whole idea we need to do more spending, we need to do more stuff, send more, put more chickens in every pot in terms of, government care of the population. And there's a huge difference between the $3.5 trillion spending bill and we're now approaching the same amount of money on a relative basis as spending as part of GDP as we did with the New Deal back during the Depression. A massive difference, though. the money spent during the Great Depression was productive. We were building things with it. Roads, bridges, railroads, and we weren't repairing them. We were building new ones. We were connecting the country from one area to another to allow people to expand their productivity and their manufacturing capacity, their delivery, and all those type of things that created much more economic growth. And, when we talk about the Depression, what people don't understand is the economy was growing at 9.5% during the Depression. The Depression was caused by the fact that banks failed and there was no FDIC insurance and people lost all their money. So, but the economy was still growing. People were still working. There was still functioning going on, those type of things. There was also a massive dust storm in the Midwest that basically just racked cattle production. So there were other factors that were happening during the Depression outside of just the collapse of the financial markets. That was only one factor of it. But the economy grew very strongly, and we did a lot of productive spending. We built dams and Tennessee River Valley Authority and all these things that were productive investments that paid for themselves over time. This bill, this $3.5 trillion bill, on top of the $1.5 trillion, on top of the $4 trillion we spent last year, has all been non-productive. Creates inflation, does not create economic activity, and ultimately has worse consequences down the road for slower rates of economic growth. We should not be doing this, but this is how the Democrats feel at this point, that they're going to get votes by giving more. If I buy your vote, if I give you money, you'll vote for me. That's the idea here. What they don't realize is they're not actually helping anybody. You're going to help them for 1 year, and then things are going to be worse off for them because their incomes haven't grown. They've made decisions to not work as much because they've got this extra money coming in. Then inflation and cost of living goes up beyond what they can afford, and they wind up deeper into the poverty line the second year. That's just the way this is going to work out. It's just simply math. So anyway, finishing up with the conversation about child tax credits. Danny, your comments.
Well, and that's exactly the same thing the child tax credit is doing at the moment. It's going to raise 40% of those families that are in below that poverty line above it. But what happens next year? One, if it goes away, that's going to be a completely different story, which it should go away. I don't think that this is, this is just going to raise the level of that poverty line, and then everybody's going to be back below it the next year.
Right.
So it's going to be very difficult, though, for somebody to actually come back and vote against this by saying, hey, we're going to take, by the way, guys, we just gave you this check, on a monthly basis. So now you're really accustomed to using it on a monthly basis. And then we're going to take it away. Don't worry about it, guys. You're going to be okay.
Right. Well, but the thing that again, this all sounds great, but what they don't factor into this is, let's say Brent, has, Brent Clanton's family child care, pre-K class service, right? Whatever. Mm-hmm. Well, any business, and this is the thing people forget about capitalism, is that if I know that Brent's getting, if Brent knows, sorry, let me phrase it correctly. If Brent knows that I'm getting more money every month to pay for childcare, what do you think Brent does with his cost, right?
Yeah.
He's gonna raise his childcare, and this is going to happen across the country. Childcare providers are going to go, government's giving you more money? Okay. What do you think happened with college costs? Everybody's amazed at tuition costs for college. It's like, I can't believe how much college costs. Well, no, duh. I mean, in 2009, the federal government takes over the student loan program. For decades, college tuition grew at about the rate of inflation. And this was simply a function of people applying for college. They went to a bank. They had to qualify for a student loan. If they wanted to get it, they had to actually have a reason for needing it. And this really kept a cap on college tuition costs. As soon as the government took it over and the colleges went, the government's paying for this? College tuition costs doubled. And then more people went and borrowed more money from the government. The government gave them more money, and colleges said, okay, we'll double it again. Let's see where the ceiling is, right? And so college costs have spiraled. And now instead of realizing that's the problem and cutting that student loan program off and turning it back to banks, making people actually qualify for it again, we're just going to forgive the student loan debt now. So now colleges are going, great, now they can get free debt. I'm going to raise my tuition even more. See, the loss of connection of what people think about in Washington and how it works in the real world is completely broken. And that goes with mainstream economists as well that have never been out of the ivory tower. They just have no clue how the actual economy works.
Well, that's a very good point, and that's the unfortunate part about how academics have been running the country for so long, that they don't actually have any clue as far as how the businesses work or how things are ran. So you talked about The Big Short. Talked a little bit about Michael Burry last week, Lance. There's a position that you actually own within the portfolio, TLT. Michael Burry comes out this week, and he is actually shorting TLT now. What do you think of that?
Well, look, there's a lot of bet here, and again, the bet is that there's going to be rampant inflation in the next couple of years. That is probably a correct statement, that we're going to have inflation from all this money printing, et cetera, those type of things. The problem is that as soon as you get a spark of inflation, you're going to wind up in a recession, because two things are going to happen. One is that as soon as you start to see a kick up of inflation, the Fed is going to start to taper and hike rates, right? They are going to fight that inflation spike when it occurs. And in fact, this week, we're going to start getting a much more clarity kind of on their current positioning heading into Jackson Hole about their schedule for taper as it is. But what will happen here is inflation spikes up. When inflation spikes up, the Fed's going to start to taper. As soon as they start to taper, that means money's going to leave risk assets and move into safety assets, which will be treasury bonds. So this will lead to an immediate reversion in bonds. You may see rates tick up here a bit. You may get a tick up in rates to say 2%. That's possible from here. That's probably about the most you're going to get, and then rates are going to run back down towards zero as soon as you hit the next air pocket in the financial markets, and money starts to rotate from risk on to risk off. And that's just really kind of been the dynamic over the course of the last decade. Every time the Fed starts doing monetary policy and doing QE, rates rise, because it's a shift in risk preference from risk off, being treasury bonds, to risk on, being stocks. When there is a risk off event in the markets, money floods back into treasuries for safety. And again, you're seeing this globally right now. Japan has been a huge buyer of treasuries as of late, as the need goes to put money into a better performing asset, which is the US dollar. So while I don't disagree with Michael Burry in the short term, I disagree with him long term, is your point.
Yeah. Okay. Fair enough. Seems like he's going to be a hot topic here as the media is beginning to pick him back up on a week-to-week basis. Last week with going after Kathy Wood and ARK, and now, shorting TLT. We'll see what next week brings, right?
Look, I'm not arguing with Michael Burry short term. I mean, there's a real risk here. We could see a pop in rates. But as soon as you have that pop in rates, the whole house of cards is going to come apart economically. And so that's, it may be a short-term trade, but I don't think Michael Burry's in it for the long term. This morning coming out, MBA mortgage applications, durable goods orders, non-defense capital goods. Those are what they call core durable goods. This is stuff that people buy on a more regular basis. Durable goods include aircraft. I bought my private jet last week, so I won't need one for a while. So we look at kind of core durables. That's things like cars and refrigerators, washers, dryers, and even those. And this is really kind of one of the tricks with durable good orders, is that that's stuff you don't buy on a regular basis. I mean, you buy a washer and a dryer once every few years. You buy a refrigerator once every few years, whatever it is. So even when you take a look at durable goods and core durable goods, you really kind of got to even get down into the more micro basis of those durable goods orders, and to really look what's going on with stuff that people buy every day, those type of things. So, but again, those are going to be out this morning. Those are likely going to be a little bit weaker. We're already starting to see weakness in all the manufacturing indexes after that surge. Not surprising. Everybody got checks to spend last year, that $1,400 checks to households. Everybody ran out. They bought washers and dryers, and they went to Home Depot and Lowe's and bought stuff to fix up their yard, and everything else. That's all done now. The checks are now fading from the system. But even if you give me another check today, I'm not going to go buy another washer and dryer. So don't be surprised if durable goods orders come in a good bit weaker than expected. Again, we're still kind of in that phase where we're seeing some year-over-year comparisons. So, I mean, it could be stronger today, but we're going to see a trend of weakness starting to show up in a lot of these manufacturing-based indicators. Earnings today, Salesforce, Autodesk, and Ulta are kind of the big earnings announcements today. So again, we put all this in our daily market commentary. Go by realinvestmentadvice.com, click on our daily market commentary link, get our latest commentary, subscribe for email delivery. We'll have it to you. Okay, Danny, getting ready to wrap up the show. What you want to talk about?
So I know one of the things that's near and dear to you, Social Security. And so I've seen a lot of articles recently.
You're saying I'm old, right?
Well, you should be starting to think about these things. I mean, come on, Lance. But I've been seeing more and more articles about filing early, and I think that there can be an argument made for people to actually take benefits prior to full retirement age or not delay till 70, which we do like and we typically do encourage. Mm-hmm. But one thing I keep seeing is that there's a lot of articles that are missing the point in the sense of not understanding that if you do take these benefits early, and this is what I fear is that a lot of people are reading these and they don't quite understand what the impact may be, is that if you're taking these benefits early, you can actually have a reduction in benefits that are going to be, number one, permanent. You can also have benefits withheld, meaning that you're not going to be getting the income that you anticipate because you may make too much income. And, we talk about diversification of assets frequently, meaning, what type of accounts do you have funds in? Where are they registered? And I think this is really important for a number of reasons. One, we want to keep as much money in your pocket as possible long term. We talk about all these spending bills, another 3.5 trillion here, not to mention everything prior to the pandemic and then the pandemic numbers, and then all the things that we're going to continue to do because, like you said, we have to get those votes. Somebody's going to have to pay for this. And so there's a lot of stealth taxes that are out there. Social Security is certainly one of them. Medicare. I suspect there's going to be a number of other ways. But the thing I continue to see is these articles fail to mention that you could have benefits withheld. You're going to be taking a smaller amount than what you would typically get. And this does impact your spouse as well. And so, looking at all of those things, I think that's really important for people to understand longer term and make sure you take that into an account. Run the numbers. Go look at the big picture. Don't just go in and say, hey, you know what, this guy made a good point. In fact, the last article I read, and he did make some good points in the sense that he said, hey, I don't have a lot of longevity in my family. My parents all passed early. This guy was Lance. Do you know what a Mexican luchador is?
I don't. I may have had one with a margarita once, but I'm not sure exactly what it is.
Well, that would be kind of weird. It's one of the Mexican wrestlers. So this guy wrote an article, and a lot of places picked it up. And I think I did have
margarita with him once.
Yeah, there you go. But so yeah, kind of cool. Look him up. The guy's name is Latin Thunder. Actually, still wrestles, but he's a factory worker. And he says, look, I don't anticipate working this graveyard shift when I'm in my early 60s. My parents all passed when I was young. But the one thing that most people probably don't take into account is that you're not going to be able to live off that Social Security. And if you are, you're going to be drawing from other assets as well, which therefore could have all those implications that we just discussed.
So how long if you're going to delay taking a Social Security, what's the maximum length of the delay you should take?
Well, look, you can only delay until 70.
Then why do you keep telling me I can't take Social Security till 85?
What? I can't hear you, huh? Yeah,
I keep saying I want to retire. He says you can't retire till the 85. So now I know.
Your financial plan does not work, Lance. I'm sorry. You just have to continue going. Don't worry, guys. For a long time, Rich and I have his plan set up very, very nice.
Gotcha. So yeah.
So the big thing is that if you take it before full retirement age, which is 66 or 67, depending on age, then you're going to get a reduced benefit. You're also going to have potentially benefits withheld if you make too much money, meaning that you may not be working, but you could have deferred comp. You could have assets that you're pulling from your traditional IRA, your 401k. Those are going to count towards that. Now, if you delay each and every year that you delay, you're going to get an 8% bump from that full retirement age. This is really important for those out there that are actually going to be, that are married, especially if your spouse is a little bit younger. If you pass, then your spouse will get your benefit. And so the larger the amount, the better, right? And so I think that delaying is going to be beneficial, especially if you're the breadwinner. And then by waiting till full retirement age, if you take it prior to full retirement age and your spouse is going to get spousal benefits, they're going to get a reduced amount as well. So this does have far-reaching implications, greater than just, like, oh, hey, I'm going to take it early. Yeah, I get a little bit less. But, most people take it early because it's emotional. Now, there are times, like this guy was mentioning, that, hey, longevity in family is not that great. Had a kind of a rough job. I don't know what my longevity looks like. Hey, I get it. But looking at the big picture, many people do it just because they say, hey, I'm getting as much out of this as I can. And unfortunately, the numbers would suggest that that's just not the case if you do actually have a little bit of longevity, which, more and more people, once you do reach 65, you're going to see that, your chances of living longer increase substantially. So, be very careful with what you read and what you see out there, and, take it with a grain of salt and understand the consequences, good and bad.
Yeah, but you brought up a good point here, talking about, one thing that could impact you is the money that you take out of IRAs and, tax deferred accounts, which is one of the things that, when I talk to people, and see this a lot, all their savings, 100% of their savings are their 401k and their IRAs. This is why it's, we talk a lot about it's so important to have a diversified account structure where you have roughly 50% of your money in something you've already paid tax on, so that when you do get into retirement, you can kind of control your taxable rate by drawing some money from the IRAs to meet your annual withdrawal rates. But you can also supplement your income from stuff you already paid tax on. So it doesn't kick you up into a higher tax bracket, doesn't impact your Social Security benefits. So, having a strategy based around the type of accounts and where your savings are is also very important to this.
Well, that's huge. And, it's great. This year we started to hear about the, Roth IRAs. They're fantastic.
Yeah.
And we've been talking about this for quite some time. And now Susie Orman, everybody else decides that, taxes are going up next year. Maybe we should go ahead and do this now.
Right.
Well, look, you're probably a little bit too late here. But look, I think anything's better than nothing. So by utilizing a strategy, starting to put funds aside to give you flexibility, that is going to be crucial. And I think it's going to be ever so important now, looking at the landscape of, where we are, what taxes are going to potentially be. And, while they say, hey, we're only going to raise taxes on the rich, I think we know better that it's going to have far-reaching implications. And it'll be those stealth taxes. It'll be the small things with Social Security. It'll be the small things with Medicare. It'll be other things that they're going to think of that aren't going to maybe it's not as obvious from just raising tax brackets. Mm-hmm. It's going to be all the little stuff that they can sneak in there that, oh, well, this is just going to be small here. So they're going to chip away little by little, and that's going to be the big impact over time.
Yeah, and it's really pretty much that is the case. And again, this whole idea of taxing the rich is, sounds like a great idea. The problem is look, you could take away all the money. I mean, you could take away all of the 137 billion or whatever that belongs to Jeff Bezos, the 150 billion or whatever that belongs to, Musk and Gates and everybody else combined. You could take away all their money and you wouldn't put a dent in the debt or the spending that we've done. And so the question is sure, yeah, we can go tax all these people more. All they're going to do is move their money offshore anyway, because they're already doing it. We have a record number of people filing for expats this year, basically relinquishing membership, U.S. citizenship and moving to other countries to avoid this. So we're just shifting that whole burden onto the middle and lower class who really can't afford higher taxes because they're the ones that get penalized. They may not pay higher taxes. They're going to pay higher prices, which is worse because you spend higher prices. Much more of your money goes to higher prices than goes to taxes. So, yeah, you may give them a lower tax rate, but this is the problem with the way people vote, too. They really don't even understand. They just say, I'm going to vote for lower taxes. That's great. Or let's go tax the rich. That's wonderful. Nobody tells them what the consequence is going to be, and it's going to be worse for them than the tax rate was to begin with.
Everybody wants to use those guys as kind of the benchmark for, look at this rich guy, Jeff Bezos. Well, look, how many people are there out there like him? How many are there that, that's
very
right.
Few.
Very
1%.
So, not even.
It is 1/10 of 1%. Yeah. All right, Danny, thank you so much. Appreciate the time today. Be back tomorrow, of course. Michael Leibowitz here to talk a little bit about the Fed, Jackson Hole. And, of course, that is the whole focus coming up here for the markets. S&P 5,000, it's in sight. I mean, it's not that far away. A couple hundred, about 400 points will be there. Can we get there next year? It's all going to depend on the Fed, really. We'll talk about that tomorrow with Michael Leibowitz. Get by the website today, realinvestmentadvice.com. Get our latest daily market commentary, our latest blog post, newsletter, more, YouTube videos, all there for you, realinvestmentadvice.com. And most importantly, if you have a question for Danny, for myself, for Richard, just feel free. Ask a question, request more information on services. It's all there for you, absolutely free, realinvestmentadvice.com. We'll see you tomorrow.
It's a rich man's world.